economy of the nation as the warning signs are getting louder. And this week, the International Monetary Fund, IMF, added to its voices, or rather its voice to growing concerns about Nigeria's fragile economy. In its latest report, the IMF forecasts that Nigeria could lose up to 0.5% of its GDP in the coming year, citing multiple vulnerabilities from declining oil revenues and weak tax collection to persistent inflation, currency instability, and mounting debt. The fund also expressed worry about the federal government's over-resilience or over-reliance, I beg your pardon, on the central bank for deficit financing, raising fresh concerns about Nigeria's monetary policy credibility and long-term fiscal health.
So what does the 0.5% GDP contraction actually mean for jobs, prices, businesses, and also household income? And is there a way to cushion the fall? Well, joining us to unpack the numbers and the implications is Dr. Obele, economist and public policy analyst. Dr. Obele, you're welcome. Thank you very much for joining us this morning. So let's start with the headline, 0.5% GDP loss. How serious is that for a country like Nigeria? Can you help us and our viewers also contextualize the impact?
Thank you. Thank you very much for having me. Really good to be here on the bright Saturday morning. Yes, so the IMF have always had views about the Nigerian economy, and to a large extent, 8 out of 10 times, Nigeria not very positive. And but if you look at the construct of the Nigerian GDP, I mean, it's hovering around 3%, 2.9, 3%, 3.5, thereabout, and all that. The construct of the GDP is such that we have over 95% of the economy currently non-oil driven, and a significant bulk of the economy is also services driven. So technically meaning that you have a lot of young people, a lot of women, a lot of institutions who are playing in these spaces. That's got nothing to do with oil. But the challenge, on the other side of things has been that the economy, the Nigerian economy, hasn't been able to activate or formalize or organize the potentials and prospects of the non-oil economy. So yes, I don't provide GDP loss for Nigeria. I would not think it so much. I won't take it too hard, because the real drivers, the real sector, the real drivers of the Nigerian economy, to my own sincere and humble opinion, is still very much intact in terms of the vibrancy of that economy in contributing to the economic growth. In as much as we haven't done enough good work to organize those sectors. For instance, we don't have a strategic national services policy that plugs into the growing digital services component of international trade, which is, at least 15% higher than the global goods traded. All right. So we have a 58% vibrant economy on services. We have 94% on non-oil sector. So that's to tell you that the potential for the economy to really grow and scale is really there, but we haven't unlocked it yet. So if you look at it from a lens of revenue collection and all that, all sector contribution, tax and all that, there are still issues, which is to a large extent where the IMF is sort of taking off on its argument. Right. But it doesn't really, the argument is not sufficient to say that doom looms for Nigerians and the Nigerian economy significantly. Because if we tap into the non-oil sector growth and into the services sector growth, and we plug it in nicely when it comes to non-oil revenue and human capital development and prosperity for Nigerians. And it's technically going to expand the weight of the Nigerian economy, the weight of the Nigerian market, the weight of opportunities available for women and young people, and that in itself will also boost GDP and GDP growth. All right. So if you compare the situation to the UK and the US and many other interesting economies, even in the EU, they're in more severe economic position than just the Nigerian economy. Right.
Well, besides just a weak oil revenue or high inflation, the IMF also said that one of the contributing factors to this prediction is the country's over-resilience on central bank deficit financing. How would you address that? And if you were to say that there are other parts or sectors of our economy that the government have not been able to tap into yet. It seems that all of the administrations, whether it's from Obasanjo down to Tinubu, it's been difficult to tap into all these other sectors. How best can they structure enough to tap into it,
Yes, yes. To start with, part of the reasons why we're having the challenges we have, that we're having to deal with the central bank trying to finance the deficits. The deficits exist to start with because there is need to scale infrastructure investments and capital investments into the mainstream of the Nigerian economy, which will then unlock the potential of the non-oil sector, all right, the potential of the real sector and all of that, and also the need for structural reforms as well. But we've seen that on one hand, when you think about it from a more broader perspective, looking at it from the context of Obasanjo to where we are now with President Tinubu, there hasn't been, we significantly underestimate the efforts, the investments, and the infrastructure, plugins that are required to be able to scale the non-oil sector, the regulatory vibrancy, the patient capital, and all of those interesting things that need to be at the fore and need to work intertwinedly in a very interlinked way to unlock the potential. And also, even when you talk about how we position the non-oil sector and businesses who are able and ready to export, how we positioning them for increased FX flow and all of that, or increased, earnings, revenue, and potential and all that. So it's a lot more to do with market dynamics, how we are governing and leading on the market front of things, and how we are resourcing those opportunities for significant, real sector players in the local economy. And I think it's a bit that we haven't gotten right, and there's sort of been a significant overdependence on the externalities or the external economy or external environment or external institutions to fund and support the dynamics. And we're seeing there's been a lot of pushback. In as much as investors' confidence may have improved, there's been lots of pushback as to the state of financing these investments. So these things must be in place to be able to unlock that. And we haven't prioritized the non-oil sector enough in terms of support, in terms of incentives to grow and all of those things for businesses or even institutions at scale in that regard. That's on one end. On the other side of things, you also want to think about the fact that currently the Nigerian economy, the economy needs to be productive to be able to resource itself at a level. Debts and all those elements are not really, really bad, at a very, very strategic sense. But the big question is that the monies you've raised before, the monies you've accessed before, what did you spend them on? Where did you plug them in? So in terms of structural reforms, we've seen how the budgets have been designed. We've seen how infrastructure spendings have been done. There's a lot of misalignment. There's a lot of poor understanding of how the economics of those governance needs to work to power these sectors that would have high returns on investment to start with. So when you don't have those strong disciplinary elements when it comes to the fiscal side and even the monetary side as well, you then begin to have a lot of situations where you're producing a budget where it literally drains out money, and the monies are not significantly invested in capital projects that have high return on investment. So these are part of the issues that we're faced with that impact generally our current economic situation. And it's also worth noting that the value of a currency or the productiveness of a local economy is also very hinged on the dynamics of policies, the dynamics of doing business, the ease of doing business, and many of these right. Basic things that need to be in place here.
Yeah.
Obele, I wanted to know, just as the IMF has proposed, I call it a proposal, this proposed forecast of 0.5% downturn in GDP, is there a Nigerian estimate that has been put forward, and when compared to the IMF's proposal, how far from it, or how far apart are these predictions? Is there a disconnect between what is real and what is being perhaps maybe hoped for in a Nigerian context?
I think there's a huge disconnect. And that's primarily because we're not telling our stories, and we're not telling our stories enough from an evidence standpoint. And there is no strategic local to regional, national aggregated efforts to tell the stories from a strong evidence-based perspective. There are always calendar cycles where the GDP figures and reports are always released. But the Nigerian Bureau of Statistics needs to be a bit more forward-thinking in terms of how we're channeling these numbers to make the case and position for the growth of the Nigerian economy. Now, when we talk about percentage growth, that talks about the difference between what the growth was the last time and what it is now. All right, it doesn't necessarily mean that the dynamics of those growth are not still in full force. It just means that it's been slower. That's what it means. It's been slower, and probably it's taken a slightly, a drop off than what it should be or what is expected. So again, in terms of what is expected, the stories as regarding how we're using data to navigate these things have to be correctly done. Because if you're focusing heavily on not just the economic potential, but what is actually happening in the economy. So, for instance, if you look at IT, if you look at finance, if you look at real estate, if you look at trading and all of those things, retail, those are the sectors that are really driving the Nigerian economy. These are high-powered sector that's that significantly have what it takes to unlock the prosperity dynamics of any economy in the world. All right, but we're not doing enough of data collection in that place. We're not doing lots of evidence-based advocacy when it comes to both the local and international landscape. And now we're using those evidences to project our positioning in trade negotiations, debt relief conversations and all that.
Right, I do have to say something though. We've been doing a lot when it comes to try to deflate, or I don't know the word, disinflation, there we go, when it comes to our inflation. They've done with the rebasing of the economy. There's also, but one thing is evident, there's still volatility when it comes to the Naira and how that is being played out. So I do have to ask you, given the rebasing, given the volatility of the Naira against the dollar, it's still dancing around that 1,500, 1,550 Naira mark. It still has not come down. It's still it's shaking on its own, shaky daddy. So I do have to ask, right, how does this play out in terms of stabilizing it for the macroeconomic, environment, but also most importantly, what can we do besides the rebasing that we're seeing that can help in sort of stabilizing our inflation ahead of the next quarter?
Yeah, interesting. There are many things to discuss there actually.
So many, I know.
Got the Naira valuation and all that. So I'll try and take it in bits in the little time I have. Number one, on rebasing. When you're thinking of rebasing, you're just trying to reevaluate, the size of the local economy and all that. We did that with GDP. It's always good when you do it with GDP. But when you do it with an economic variable like inflation, it can be pretty tricky. And to me, I don't think that the rebasing was the most strategic thing to do. That's number one. Secondly, I also thought it wasn't a very genuine reflection of the state of prices in the Nigerian economy right now. So whilst the rebasing was done and sort of managed the numbers a bit, if you also realize that the inflationary basket has not significantly changed. There are many elements in the real market space right now in Nigeria that are shaping prices. So for instance, if you go buy a Mac laptop at Computer Village and even a fairly used one, you can imagine how much that will be now, compared to what it was 2-3 years ago. Many of these technological devices and equipments that really shape pricing, particularly these equipments that are done in informal markets, by the way. They are organized but highly informal markets or informally organized markets, whichever way you look at it, because they're not formal and organized. So because they're informal and unorganized or informal and organized, you have a situation where prices are not really regulated. You don't really have a strong data point as to how many, for instance, laptops and iPhones or Android phones are sold every day in Lagos. You don't have that data. Well, that data sort of exists, but it's still very informal. It's informally disaggregated. So until you begin to factor in those significant purchasing elements or consumer elements into the inflationary basket, you don't really have an ideal sense of what the inflation truly is. Now, when you now have an ideal sense of what it truly is, then you can then talk about rebasing. How do you rebase off the back of a realistic basket? All right, so we went to rebase off the back of an unrealistic basket to start with. So the numbers are not really a genuine reflection, a true or accurate reflection. Emphasis on the word accurate inflation, a reflection on the state of the cost of living or inflation. And also it's important for me to state that inflation has also evolved into a deepening cost of living crisis because we are not doing the hard work to look at inflation from an angle of the non-structural and the non-monetary elements that are impacting on inflation. We are then losing sight of the key consumer dynamics that are also shaping cost of living crisis. So inflation has now evolved into a deeper problem called cost of living crisis because people are having to buy a basket of tomatoes at a more expensive price than they should. But when you now look at inflation from a more policy angle, people are using, not really people, banks and central banks are using interest rates and all that. And to me, that's very reactive and not really proactive in the times we live in. So there's need for us to rethink that rebasing. I don't think it was a very reflective. If you look at the street inflation right now, it's way more than what it was before it was rebased. That's number one. Secondly, on the conversion of the currency, every currency is hinged on the productivity levels of the local economy. not on the support you get from external government or on the applause you get or on the show of increased investor confidence. No, the value of your local currency is hinged heavily on the productivity level. So the more productive your local economy and the more productive you are in external markets, in your negotiations, in what you have to take when it comes to trade negotiations and trade engagements, the more stronger your currency will be. And particularly if you're able to lobby at the highest level of global trade governance and all of that, then it sort of protects the value of your currency. So right now, the Naira is really subject to lots of global shocks, global fluctuations, because the key things and thematic areas or thematic sectors or institutional elements that should strengthen the core of the currency have been neglected significantly. And also, if you think of the fact that, there was this whole argument about Naira fluctuations and allowing the currency to float. It was, in my own opinion, I don't think that was one of the very best things to happen in the sense where it happened at the end of the day, but I think it could have been phased a bit more, because what then happened is you left the Naira to the flow of demand and supply, and that's what floating means. When you leave a currency to float, you allow the forces of demand and supply. So when you leave a currency to float where the supply of that currency does not meet the demand of the currency, what happens? It's very simple. So if I've got 2 slices of bread and I have just a tiny piece of butter, you realize that you won't be able to put that butter won't go round enough on the bread. You won't have enough on it on the bread. And that's what happens. The demand for dollars, healthcare, tourism, and all that does not match the supply for dollars. All right, in the local economy. So what happens is that the cost of $1 to a Naira would go high because the demand for outweighs the supply. It's just simple economics principle. When the demand for fuel outweighs the supply of fuel, the price for a liter of fuel will go up. It's just very simple. So when you look at it from that angle as well, and you now choose to float, it now means that you left a vulnerable currency to market forces that are not in the first place, in quote and unquote, relatively balanced. You don't have enough supply to meet up with the demand. So when you let the currency float, what will happen is the currency, the exchange rate will be expensive, will be higher, to be higher than the equilibrium price in this context. So that's what has happened. When you have a productive economy, what happens is that you're able to attract the dollars in enough supply because you have something to give in exchange that is valuable in proposition, in productization, in strategy, in marketing and all that of the made in Nigeria and all that interesting stuff. When you do all those dynamics, you're able to attract the dollar enough in supply to compete with the demand. When it competes with the demand, in fact, part of competing with demand is also disincentivizing the elements, incentivizing the elements that attract people to go for tourism outside the country. So build the hospitals here, establish healthcare institutions, create a cancer survivorship center so that people abroad can come and spend their
medical tourism
pounds in Nigeria, finding more cultural competent care to cancer. And those interested. When you begin to do that, you reduce the weight of the demand on dollar. You've increased the supply outside on all that. And because what's going on, it will now reach a genuine exchange, which is what we term as equilibrium price.
Dr. Obele.
Yeah, I don't know if you get what I'm trying to say.
Yeah, we do. I wish there was enough time for us to continue with this discussion, but like you said, like you rightfully put, that was a thesis question. Forgive me for throwing that at you. I wish there was enough time to dig in, but you have made very solid analysis as well. Once again, thank you, Dr. Obele. He is an economist, giving us a bit of insight following IMF's forecast of a 0.5% downturn for Nigeria's GDP.
I also wanted to say thank you for using the illustration of 2 slices of bread. That just makes us hungry. But thank you very much.